This video will introduce you to my two-wave trading strategy. I call this the macro-microwave strategy. It takes advantage of two waves, surfing them to achieve strong returns with small drawdowns. The risk is always smaller than trading the underlying stock, and the probability of having a winning trade is always higher than trading the stock. This strategy combines time-tested, winning investing principles with several of the latest trading ideas. These new ideas give us the ability to control the risk and probability of having a winning trade. We have a marriage between SPY, an exchange-traded fund representing the S&P 500 index, and TLT, which is an ETF which represents 20-year Treasury bonds. The macro-microwave strategy covers what to enter along with the entry and exit criteria. My SPX hold timer corresponds to the macrowave. The timer is based on the 25 bar of the weekly SPX. It reports only two market states, bullish or bearish. When the timer is displayed in green, the market is bullish. Otherwise, it shows red, indicating a bearish market. The timer indicator signaled the start of the bear market in November of 2007 and remained negative until early 2009. Only one set of parameters was used over the entire test duration. Optimization was not used to determine its few parameters. Whipsaws were not evident. When the macro wave, namely the SPX hold timer, is bullish, we trade a SPY bull-put spread. The short strike is chosen with a 75% probability that the trade will expire out of the money. If the timer is bearish, we trade a similar bull-put spread on TLT. Each bull-put spread has a POS, a probability of success, of at least 75%. Meanwhile, if we simply had traded the ETF, SPY, or TLT, its probability of being a successful trade would only be 50-50. These spreads are also called credit spreads. When the trade is placed, the account receives a credit equal to the price difference between the long and short puts. The risk associated with the spread is the price of the ETF reduced by the amount of credit. The risk when trading an equity is equal to its price. As a result, a credit spread always has a lower risk than trading the equity. This shows an image of a Thinkorswim trading page. The columns outlined in red contain the probability corresponding to each strike. Out-of-the-money trades are displayed with a white background. As you can see, further out-of-the-money strikes correspond to higher probabilities and lower bid-ask prices. This is a Thinkorswim chart showing the 25-bar Hull moving average of SPY. This is SPY's microwave. It's bullish when green and bearish when red. The status of the microwave is similar for TLT. When the microwave is bullish, we take a profit exit as soon as it exceeds 1/2 the credit. We do not wait until expiration. A stop loss is set at the risk divided by 4. When the microwave is bearish, the stop loss is reduced to the risk divided by 8. Most important, entries are not permitted when the microwave is bearish. Money management is used to reduce risk even more. It is important to protect against the remote possibility of multiple consecutive losses. We do this simply by limiting the trade risk to 25% of our investment equity. This is usually the current size of the account. The macrowave has you trading equities in rising markets and bonds in falling. The microwave is an indicator that directs when it's time to be aggressive and when to be protective. When the macrowave changes direction, the trade must be exited. When the microwave changes direction, only the trade guidelines change. While a 75% probability of having a winning trade puts the odds in our favor, taking the profit at 1/2 the credit dramatically improves the daily return per trade. Furthermore, it allows us to place more trades at the higher daily return per trade. I've shown the basics of the macro-microwave system. These alone achieve the objective of high returns with low drawdown. Now I'll show some refinements to the microwave component of the strategy. These will be based on the shape of the wave. At the beginning of the wave, its lowest part, the strikes will be moved closer to at the money. While this reduces its probability, the credit increases due to the increased trade risk. The risk is calculated from the theoretical value of the options. This value does not take into consideration the shape of the wave. The older a wave, the greater the likelihood its status will change, so the strikes of new trades are moved further from the money. The effect is to increase the probability of success, reduce the risk and the amount of credit. Two other refinements are introduced. After a losing trade, we wait 1 extra bar before re-entry. Once a trade status is bearish, any profit will close the trade. The greatest threat to the macro-microwave strategy is a whipsaw in a microwave. Fortunately, these are minimal. This chart is showing a 2-bar whipsaw going from bearish to bullish and back to bearish. There were 8 occurrences of this type of whipsaw. One of these produced the largest drawdown during the strategy backtest. These statistics cover the test data from June of 2008 through the first quarter of 2014. They demonstrate that this strategy is truly robust. Of the 130 trades, over 82% were winners. Trade duration was short. These are the result of choosing trades with a 75% winning probability and setting the profit exit at 1/2 the credit. The drawdown was tolerable compared with a phenomenal annualized rate of return, particularly if you look at the drawdown quarterly. The 31% rate of return of the account equity is even more amazing when you realize only 25% of the equity was at risk per trade. The chart of return shows only 2 quarters had losses greater than 5%. By far, most had winners exceeding 5%, with over half of them earning more than 10%. Even though the market showed significant variability since mid-2008, the strategy had a slowed rate of growth only momentarily, and that wasn't during the crash. It grew from $100,000 by almost a factor of 5 in less than 6 years. All of this growth was achieved by surfing our two waves. There is little more that needs to be said. No broad-based mutual fund and few other types of funds could match this performance over this period. Even though options were employed, this strategy demonstrates they can be safer and more productive than trading stocks and indexes. The macro-microwave strategy is highly intuitive, buying equities in rising markets and bonds in falling markets. It is structured around buying the microwave at its low and being defensive when it's high. Its simple money management is highly protective of equity. This is particularly important for retirement accounts. If you have any questions or comments, do not hesitate to contact me at levitt@buffalo.edu. I appreciate your watching my video and any feedback you might have.